I'm leaning towards the better from here, in part because of what was already said on valuations being around 14.5 times. A lot of bad news is priced in. The U.S. consumer is in a beautiful place right now with a strong jobs market and gasoline prices that are down 22% from October. So the consumer, which drives the U.S. economy, is in a great place. So I'm leaning a little bit towards the bullish. I also think President Xi in China and President Trump here are probably a little more eager to get something done by March. But I don't think we're necessarily out of the woods. I want to temper my enthusiasm a bit and have, as John Williams said from the New York Fed recently, eyes wide open. We don't know if we get a trade deal. We don't know how Brexit will play out. We don't know how many U.S. investigations we're going to get around this administration with a new Congress, how that could play out, what's going to happen with the debt ceiling later this year with a divided Congress. So I'm staying invested. We have some defensive exposure in our portfolios, and we're leaning towards a better year this year than last year, although the bar is low.
What do you think the Fed does? You mentioned John Williams. I mean, that's a big wild card. We don't know whether there's going to be a rate hike and whether that upsets the market. The market seems to want none here forward until the Fed has a chance to really sit back and take a look at how the global economy is going to do.
I think that the Fed, I mean, I would just read what he said the other day in his speech in late December. And again, we're going to have more Fed speakers this coming Friday in Atlanta. You know, eyes wide open, reading the data, watching the markets. Yes, their focus is jobs and inflation, but they also look at financial conditions and how those affect the overall economy. If we get a sharp fall in business sentiment surveys, the ISMs, the PMIs, which seems to be playing out, that's something the Fed's going to take on board because they know those surveys tend to lead actual economic activity. So I think we could get a Fed pause for a while. I don't think the market's necessarily wrong there, especially if trade doesn't resolve quickly. What I think, though, one has to also think about is that we have passed an inflection point for global central banks. If you think about 2009 through 2015-16, you had QE around the world. You had this trend. That's changed. The European Central Bank is no longer adding to its balance sheet. The Fed, even if it doesn't raise rates this year, its balance sheet is coming down. So what was a rising tide lifting all boats for the last decade almost has changed. So even if we get a pause, this isn't going to be the Fed riding to the rescue the same way it might have a few years ago.
Yeah, those looking for the data to be, weaker. Here we are back in sort of bad news is good news again. You can't have your cake and eat it too, though, right? If the market's pulling back because worries about global growth, and then you get bad data thinking that, OK, that's going to firmly put the Fed on hold, that's going to be good for stocks. I'm not sure it's going to work out that way this time.
I would agree with that. I don't think the Fed can necessarily give you that put, so to speak, that it had in past years. I think the Fed can provide an offset to help calm sentiment, but I don't think it by itself can turn things around. If we do get some progress on trade and the global economy is stronger, well, then the Fed is more likely to raise rates later this year. If we don't get trade and the global economy slows further and sentiment's terrible, that might impact the Fed's thinking. But is a Fed pause enough to offset all that? I don't think so. Again, I'm leaning towards that slightly optimistic camp that we will get something on trade and that we can get better returns on equities this year with still decent global growth. But there's enough risk to that view this year that I think one just has to go into it kind of hedging your bets. So we have neutral equity exposure. We're not getting aggressive despite the valuations here. We have some defensive pieces in our portfolio, and we are staying overweight the U.S. And I know that sounds funny, given a lot of this is U.S.-centric, but because of the liquidity of the U.S. market and that flight to safety we tend to see into U.S. Treasuries when times go bad, we think the U.S. on a longer-term basis, not just December, but on a longer-term basis, is going to serve us well if things do play out poorly.